Great.
So we're live, and Prince, you want to take?
Yeah. Hi everyone. Good morning. Welcome again in another session. So today we have with us Sarvesh Gupta from Maximum Capital, and by education he's an IITN and IIM graduate. And more on introduction will be added from my co-host Rahul Roy, who will be leading for today. And Rahul, over to you.
Okay, thank you, Prince. Thank you so much, sir, for taking the time out and doing this.
Thanks, Rahul. Thanks, Prince.
So before we get into the journey, how it started, I think we should spend at least a few seconds on, what's happening right now because, the situation is constantly escalating. At least that's what it seems to be. And how are you kind of thinking of it from a money manager's perspective and generally also?
Sure. So I think the current situation is still very much in the initial stages. So I think we haven't taken any portfolio related decisions. Obviously, in these times, there are certain sectors which start doing relatively better compared to others. But ours is a more long term sort of approach. So I think there can be some opportunities in the market for from a short term perspective in certain sectors, and also certain sectors might be a little bit down also in this interim period, but we haven't sort of changed our overall portfolio positioning because of this particular event. At the same time, I also feel that most likely a very high probability is that we'll come to a certain level and then things will start moving on the de-escalation side. So I think probability is still very high that things will iron out in the coming few days, if not next 2-3 days itself.
Right. So on the sector part, what are these sectors that, in your opinion, do well? Obviously, I just want to make sure for all the viewers and listeners that nothing that is discussed here is, financial advice. Please do your own research. So that goes without saying. But sorry, on the sector part.
No, from a very short-term perspective, till this lingering war sort of a situation or remains, I think, of course, sectors like defense can do better, and the sectors which need a lot of money from the government from a long-term perspective, like infrastructure, etc., may take a backseat.
Right.
So that is what is playing out also. But again, as I said, this is also, these things can quickly change and the same may or may not help. So from a very short term trade perspective, of course, we have seen a lot of defense stocks perking up and all that.
Right. Right. Yeah.
In
Even
fact,
the
yesterday, very
idea
funnily, some of these drone companies, they
idea
were on
of
upper circuit because of the kind of news which is flowing in. So, but I think these are just part and parcel of the market. In the short term, yes, I mean, if someone has rightly got into these sectors, they can make some money, but you never know when things will change.
right.
For a long-term investor like us, things do not change. I mean,
Right.
everything remains the same. Yeah.
Yeah. On the second point, and we'll quickly move on from this. You said that in your opinion, this should not last very long. That opinion is drawn from like what reasoning? How are you thinking about that?
So India has much more to lose, right? I mean, compared to Pakistan, which is under anyways an economic problem, India has been doing quite well. So from India's perspective, I think it will make sense to sort of, not go beyond a certain level. And I think given the geopolitical sort of relationships that India has, I think we will be able to drive down that point to Pakistan as well. So net, I think India would definitely not want to escalate it beyond a point. Pakistan has its own share of problems also, including financial issues and having very less amount of money to be able to fight a war or a conventional war for a long period. So they also know their weaknesses. So I think everyone would look for a face saving where both can claim some sort of a
A victory. Yeah.
victory in the end, and that is what is most likely outcome that is going to happen.
Right.
India, anyways, I think now with this first attack that we did in through drones and all that, I think India, anyways, have sort of showed to its population that what they wanted to show, that they are not weak. So I think India's task is anyways done.
Yeah.
Now, as long as we don't incur any major sort of casualty because of their response, I think we should be fine.
Right. Right. Makes sense. Makes sense. Net, I don't think war is beneficial to any country.
Yes,
I would
yes,
say.
yes.
Like we're also going to lose out on a lot.
Definitely. Both will end up to be losers in case such a situation happens.
Right. Anyway, so coming back to our sweet spot, comfort zone, let's talk about, starting from how you got started. Basically starting from your early kind of days, or were there any instances where you thought that kind of pushed you towards investing? Was there somebody in your family who did it, and how did that evolve all the way up to, once you start actually working?
Yeah, so my father used to work in sale, and stock markets was his hobby at that point of time, like many other retail investors, and that's how I initially got sort of. I mean, maybe it was natural for me to get attracted towards it, but initially I did get attracted towards the stock market because of that. I think during my higher education itself, I was sort of dabbling little bit into shares and all, advising my father on to buy and all that, and taking also active participation in the decision making.
Right.
And that, so there was some initial interest, because of which once I finished my engineering from IIT Kharagpur, while I joined IBM and I was in a software role, but still I was writing my CFA exam while working as a software engineer, because my ultimate aim was to enter this area.
Hmm.
And thereafter, when I went for MBA, I wrote my CFA level 2 also at that time, and because of all of that, I was able to show to the prospective employers that I have interest in the areas of investing. And fortunately, I got placed into a private equity firm straight out of the campus. So I worked with that private equity firm for around 5 years, during which I was actively also looking into public secondary opportunities which were being shown to us. And that's how I was able to sort of transform my initial interest into sort of thinking into these things into more professionally, how to do it at a scale.
Right.
At the same time, I was also have been a very active reader. So obviously, like a lot of us, we start from basic books on Buffett and value investing, like Intelligent Investor, etc.,
Right.
and then move on towards reading more and more. So I think that also helped me a lot in terms of shaping my investment philosophy, and I went more towards being a value investor. I also felt while working in private equity that, given how my inclination was more towards investing into ideas where the valuations were a little bit on the lower side, I think the public markets provide a better opportunity for a value investor in India than private equity, which is more geared towards growth sort of investing. So that is why I sort of made a move after having worked in private equity for 5 years, from private equity to public markets. So I joined another PMS firm, which was started by a gentleman called Nikhil Johari, who used to head some of these foreign owned mutual funds in India. And so that firm was Trivantage Capital, and I became the fund manager there. So after working there for a couple of years, then I started to sort of set things on my own. So again, the idea was to do something on my own. I mean, generally, if you find that you have a particular idea and you want to do things in a particular way, I think it's a good idea to set up or do something on your own, because then you have the flexibility in terms of sort of figuring out what investors to take into your fold, how patient you want to be, and also to not get affected by all these short term market movements which keep happening.
Yeah.
So with that idea, initially we started as an RIA and worked with that license for around 4 years, and then moved to setting up of Maximal Capital as a.
Right.
So now we have just going to be completing 3 years in our PMS journey
Right. Right.
in the next 10 days. So that's been the journey, and I think one common thread has been my focus and preference towards doing value investments. So regardless of the market cycle, regardless of the valuation cycle, I think we have always almost stuck to value investing. And also, I think a lot of people in the market say that they are value investors, but end up picking expensive things. But I think we have been very disciplined on that particular aspect, and that has helped us to develop a decent track record.
So, Sarvesh, one quick question on value investing. So, from last 3 4 years, banking and financials have been in the value zone, right? And being a value
Yes.
investor, don't you think 3 4 years of time, say if we go for that particular pocket, and being a fund manager is a bit time, so as to take a call on those picks, and obviously they have underperformed the broader market in last 3 4 years. So how you make a segregation is my understanding little
Yes.
here and there on this,
No,
or
that's a
maybe?
very valid question, Prince. So what I think many of us who have been value investors for a long time have learned through the time is that value by itself is not going to get you the alpha. You also need to focus on the triggers. So I think when things are cheap, one should not just look for, that one should not just invest just because they are cheap. One should also always look for triggers, and I think those triggers are the most important thing. So I think what is happening in the market is that if something is cheap but there are no triggers, for example, if you look at HDFC Bank, right? I mean, so prior to this 1 year they did not perform. So one of the reasons why it did not perform was because the overall financial growth has been coming down. So if things are not stacking up in your favor, then you should look for other value opportunities.
Right.
So that is very important, that you should be able to judge that if there is a movement towards, if there is some trigger which is playing out. So it could be a demerger, it could be promoter change because of which things are changing. It could be just the fact that the financials are improving. So I think a lot of value situations remain in value situations for a very long time, and you rightly pointed out. And it is because there is no trigger. So in those cases, I think one should keep tracking it closely, which is what we do, and then you have to strike at the right time, because otherwise your overall IRRs can be sort of subdued. And this is a lesson that because I've been doing this for last 15 years, so maybe it took me 10 years to realize this completely. But this is a very important part of value investing.
Are there
Without
examples?
the triggers, there is no movement in the stock prices, and then you are just holding it, and that may not lead to satisfactory or very good returns, especially when you are operating at a smaller base. For a mutual fund, it's a different thing. They just want to have nifty like 10-11% returns. But if your expected returns are much higher than that, then you have to also be smart about picking the right value situations.
So are there examples in the past where this worked, where you were not able to execute in the manner that you explained, and where it worked, like stock examples or companies that?
So where it did not work, of course, I can give you one example. A company called Methan Alloys, right? I mean, it's probably one of the cheapest company in India. But the problem has been that
There are,
the promoters, they just don't know,
they've
what
become
to do
fund
about it.
managers. I'm sure you noticed.
They've now started investing on their own. So I mean, there are activities that they are doing, which is why the stock price is never reflecting the real sort of value which is there in the company, and it will remain like that. So we also sort of had invested in the company, and we made good money in the initial stage, but then it remained at that level for a very long time, and the reason was that there was no trigger, there was no major expansion happening, there was nothing to be done. There's a lot of cash in the company, which is probably more than the market cap of the
Yeah.
company, but then there's nothing else which is happening. So then we sort of maybe made very little returns in the last couple of years of our holding, but then we sold out because of that. And so that's a classic example, or there's I wouldn't take a name, but there's a rice company, for example, right now, Delhi based,
Right.
and where there's a lot of value which has been there. Now of course triggers can emerge, as we were speaking, because one part of their business was not working for a long time, but till that happens in a substantiative way, that has remained in that value zone for a very very long time. And there have been other reasons also which have not been resolved, because of which it remained in that zone. So this is where the value get locked, right? I mean, you have to understand that what are the reasons why market is not giving the right value, and if those reasons are not amended, then maybe the value will continue there for a very long time, and it will produce very. But at the same time, if you are tracking it, at least whenever these companies are there which are mind-bogglingly cheap and attractive from a valuation perspective, we do track them every quarter, and we sort of see if there are any triggers which are going to play out, and we want to play only when the triggers are there. We don't mind paying 20% higher for something which is 50-60% discount to its fair value, because we can still make very good returns. But we don't want to just sit on without knowing what is going to happen. So that is one. And of course, there is a case, for example, we invested in a company called Mastek, and again now we have exited, but Mastek was a 10 bagger for us. So we invested when we found that the company got affected by Brexit, and because of which the value was created in the company. So because the company stock price came down by half, and at that time mid cap IT companies in 2018-19 were anyways very cheap, in trading in single digit price to earning ratio. So one was that this was a temporary hit that they had taken, so we understood that this is the temporary hit. In fact, it would be net positive for the company. Mastek is the only company in India which probably gets 80% of its IT services revenue from UK, or 80% of the profits. So they got enormously affected because of that, but we thought that this is a temporary situation, and that is how, once things started playing in their favor, and then of course post COVID, many other tailwinds also helped them. So because of which, the stock actually went up 10x, and we were able to thankfully also realize that sort of the full return. So sometimes these situations can also create a lot of value.
So now this is the interesting part, because आपने बोला कि temporary है.
Yeah.
So that judgment is basically the skill of you becoming a better investor over time, because
Yes.
to know whether something is actually temporary or not temporary, this is where most people who are trying to learn and get better is where the issue is. So how did you gauge, or in either of the instances, कि दूसरे केस में आपको क्यों लगा कि अब चेंज नहीं होगा, और इस केस में आपको क्यों लगा कि ये टेम्पररी है? एनी मतलब आई नो इट्स अ लॉट ऑफ
Yeah.
वर्क,
So
बट
it comes through experience. So with experience, I think there's a book called by Malcolm Gladwell on on the fact that once you have spent 10,000 hours in doing something and acquiring that sort of expertise, then things come to you in a intuitive manner. You don't even have to. So I think it was mentioned in that book that firefighters who have been doing that, they come to know intuitively that there is a problem in this room and not that room. So I think when you are a full-time investor, and especially when you are doing it in an entrepreneurial way and not just being an employee of a company, I think the lessons that you imbibe by your mistakes enter your blood. And it just I cannot tell you why it happened, but it just struck me that these could be temporary and these could be permanent. But of course, the quality of management also helps us, because there are some managements who can be sort of valued in terms of what they are saying, and there are some management who cannot be. So I think that also helped us in these few instances where we can see the track record of what they have said and what they have done. And in some cases we are able to then say, okay, the management is saying things will improve, most likely that it will improve, and vice versa. All a probability game.
Yeah.
And you will end up to be wrong also at times. But I think if you're doing it by understanding the track record of the management and by your intuition, then if you have done that enough mistakes in your life, then I think it should net be a probabilistic game in your favor.
Right. And you earlier alluded to the fact that you started off from a private equity background. And I was going through your website, and there you'd said that we do primary research by virtue of the fact that you had started
Yes.
from. What does that mean, if you can help us understand? And what does primary research look like?
So it you know it it matters in a lot of ways. What happens in private equity situation is that typically you are sort of developing that deal over 6 months, 8 months, especially the buyout deals where you are spending a lot of time. There have been instances where I have personally spent like 6 months in the company headquarters. So you begin to appreciate all the qualitative things which are beyond the numbers, and they matter a lot. They matter a lot. For example, today you have to scale the company, right? You can only make money if you can scale, and no businesses can scale if you don't have decent management, not only at the top but also at tier 2, tier 3. For the company to scale enormously and to get that 50-60 times multiple, you need that strength in management. So one thing, for example, very funny enough, when during my private equity days, one thing I used to do was to do this bathroom check. If I see that there's a promoter who has his own nice bathroom just for the CEO, but in the employee section everyone is going to another bathroom which is shit, then I don't want to invest in that sort of a company, because that means that there is no talent who will be attracted towards this sort of a company. This will always remain a lala company, and this cannot scale beyond a point. Now, these are there are so many nuances of it, but this is just one fact, and this is what we try to do in the companies that we are investing, even in public market. We are trying to see, there are too many public companies also which is essentially just a single person organization. So those companies can never scale, or there are companies where the promoter does not want to create wealth, or there are companies where promoter is very much distracted from his primary pursuits. So there are many such instances, where you need to do that deep dive and to understand the quality of there are many companies that I visit which are on the second floor and third floor. So I think, generally those companies, in a dingy office and all that, you are not going to create a lot of wealth if you are having such sort of a. So we have that banya mentality when we buy the shares, but promoters need to also have a vision and to expand things in a way. And if that is not there, then beyond a point. So we do a lot of such checks. This is just one type of check, but there are multiple things that we try to do to ascertain that what is the long-term potential of the company. Because
Right.
from a 5 to 10 years perspective, that becomes very important.
Right, right. So is there a way you can broadly capture? I'm sure there are many finer nuances within each subcategory, but let's say that, or recently, or maybe a company you're not holding in a portfolio and you started to evaluate. Most investors would go through the financials and what's available and all that, and I think that's a good source of information. It can be very effective. A lot of people have been very successful without necessarily being on the ground. But this is in addition to that. So what kind of checks come in when you're doing the physical and the primary research part of it? Just broadly, like how does it work?
Yeah, so the most important thing that you also have to develop over all these years is your own network, right? Today, for example, more than my own employee or the analyst team, I would be speaking to a lot of smart guys. Within those guys also in the market, there are many people, but very few people have that depth. So you have to understand that who are these people who have the depth, and then talk to them and then figure out a lot of these things. A lot of the situation that somebody would have already taken a deep dive. The beauty of investing is that in India, there are so many companies, so you don't have to be stuck to something just because it was your idea or something like that. If sometimes I talk to some company about someone who might be in that sector, so within the sector also we have experts, and then we try to take their opinion also. In fact, within our investor profile also, because now we have a diverse investment profile amongst our PMS investors, which are more than 100 people, all of them being HNI and doing very well professionally in various sectors. So that also becomes, a very important. I was looking into a very new company which was related to some dentistry product. So the first thing I did was to talk to some of my investors who are actually a dentist. So things like that. So there are many things. Of course, the usual things that we people do is to figure out, the LinkedIn search, or the EPFO related, to see if the employees are growing or if the numbers are matching. So there are many facets of primary research that one has to do, but those come later on. Of course, the first filter is always anyways the secondary data, and the secondary valuation data, the historical valuation of the company and where it is right now, of the sector, etc., etc. And in case we want to take a deep dive, then we do all these things, because these things take a lot of time.
All right. So I can think of one example in my limited experience where we visited a Gaziabad plant. It was a forging company, and they had recently changed their name to Forgings when the entire sector was doing well. And when actually that was one of the first plant visits I did, and it was really funny because to see their office and to see how the setup was and to interact with it changed. I came back thinking I'm not going to give this guy a single penny. Like it was so obvious in that case. Maybe in some cases it's not that obvious, but it was really insightful. And so I think that was when I started to realize, at least in my journey, where on the paper it was such a great company. Operating margins were high, they were stable, there was growth, all of that. Brokerages, known brokerage was extrapolating 5-year growth and all. And once you go there, you're like, there is no chance.
Yeah, exactly.
It makes
Those so these things matter a lot. And especially, so that is why actually in our PMS equity fund, we actually, because a lot of these things cannot be judged if the company does not have a public listing track record for a long time. Because the other thing which is very important is what the promoter has said, what he has done. And that is why typically we don't invest in many of these companies which get listed quickly or do not have that sort of a history. History becomes a very important check, and of course all these primary checks are equally important.
Yeah, 100%. Coming to your present setup,
Yes.
because we are obviously a little limited with time. But coming to your present setup, where you started PMS, you kind of evolved from RI, if I'm not wrong, between 2017 to 2022, and now evolved into a PMS. What does your investing philosophy? I know you're value oriented. Maybe I can say you're also geared towards more concentration, if not, whatever that means in your particular case. How do you think about ideas now? Like, what's your portfolio construction? All of that. Can you give us a sense of that? What sectors are there? Sectors that you kind of like to stick to?
Yeah, no. So ours is a sector agnostic. So we keep tracking all the sectors. But of course, at some point of time, there are sectors where we can see more value, and there can be triggers, as I said, not just the value, but the triggers should also be present. So I think then we become slightly more sort of overweight on those sectors. And at the same time, there are sectors which probably we don't understand very well, so we stay away from few of the sectors.
Are financials one of them?
No,
Because I
financials
know
is
it's
one
not
thing
in
that
your
we
case.
understand well.
Yeah.
So we sort of invest in a lot of those companies. But for example, something like pharma, where our exposure would be limited. Pharma and chemicals, cement, there are two, three sectors which we don't invest much in
So
because
why cement? Sorry to interrupt. Why cement?
cement. I
Because
mean.
it's not hard to
In India,
understand.
cement companies are much more expensive compared to any other sector. So
Right.
that's a mystery. They don't trade
Like a commodity
like
business.
usual commodity sectors. There are some reasons also, you can't import it and all that, but still I think in general, so relatively if one has to pick, then that is a different thing. But generally we also like to see the value in the absolute sense. That is one of the reason. But and also we don't see a lot of growth in volume terms. Generally it is more pricing related, so it is more like a macro call of what is going to happen. But we are not averse to it, but we just wanted to tell you that some sectors where we have little bit lesser sort of interest in general. Yeah, I mean currently I think NBFCs are looking good. So more than banking also, I think that is where we are focusing. Microfinance is, for example, turning up. So that is also one area that we are looking actively into.
Right. So you were looking into housing, matlab, NBFCs, yes, for the longest time. And I personally am a little bit inclined because I've spent a lot of time there. I was
Yes.
naturally curious about it, though it just
So
happened.
NBFC is the big thing. If you look at typical NBFCs now, why we are so one thing which we also look at into the is their historical valuation. Most of the NBFCs in India right now are trading at their all time low since their listing. And I can at least, I mean, there are more than 10, 15, 20 companies I can name which are trading at their all time low. And then at the same time, there are now triggers emanating because of interest rate cuts, asset quality challenges finally getting behind us, and the government also adopting a more sort of a easier pro growth sort of an approach than recent RBI governor stand. So I think so this could be a beneficiary because of a confluence of many such things happening. So yeah, I think one thing which we are also always looking into is, are there sectors which are trading at all time low? I think there are paper companies now which are also trading at an all time low price to book. So whenever those sort of aberration happen, then you have to at least look into it and figure out. But as I said, I mean, you also have to understand if the problem is temporary and if there are some positive triggers happening. If the numbers are not going to improve, then it can stay at a low level for a very long time. So that is where here we feel that there are some NBFC companies in which numbers are going to steadily improve in FY26, FY27, and market re-rating should also happen.
I have a lot of questions with regards to financials, but I think that's a conversation for another time.
Yes.
You mentioned, sorry, I'm losing my train of thought. I had a question in mind, but anyway, so until that comes, I want to move on to the next part, which is I was reading that the word concentrated portfolio has been used in a much, different communication. So what does concentration mean
Yeah, so concentration itself is also a function of the market. Again, we are not fixated that we will always be very concentrated. So there are times when there are relatively lesser opportunities which are present in the market, and then we try to be more concentrated into the ideas that we like in those times. And in those times, something that we also do is special situations. So if you are not finding enough ideas in the market, then we will look into some of these special situations much more actively than we do otherwise. Second is in times like these where we find that there are, after a fall, for example, a lot of companies have fallen. And the fall has been broad based. Any company you can pick is down 30-40%. So in some cases it is justified, but in a large number of cases the fall has also been much more than what was justified. So then there can be a case sometimes to be relatively less concentrated. So right now we are adding slightly more number of companies. So but even then we are fairly concentrated if you compare it to a usual PMS or a usual mutual fund. So our high concentration would less concentration would mean maybe 20 companies. High concentration can mean 12-13 companies also.
Right.
So that's the sort of the setup, and then within the sectors also we try to diversify anyways within,
Right.
irrespective of the number of companies.
Right. So, is it Prince? You want to ask something?
Yeah. So,
Yeah.
Sarvesh, to ask you on the size of the capital, so do you think at any point in time size becomes a hindrance, as in like where you can invest and those kind of situations? And on the top of that, second question from my side would be like client communication, right? That is very important. So how you go about on that front? Because when you onboard new clients, then there has to be some element of confidence which you get whether this person is seasoned enough or behaviorally conditioned so as to you need not be putting extra effort during volatile times so as to make them understand rather than upfront onboarding practices wherein you can do some hygiene check on their behavior or understanding of the market because normally the participants are more interested in times of euphoria, and when there are bigger opportunities in volatile times, they tend to be fearful, is what normally
Yeah,
happens.
yeah, yeah.
Basically, how do you attract the right clients, right? If I
Yes,
can put
yes,
it.
yes. So the first question, sorry, I forgot your first question.
Yeah,
Second
it
question,
was the size of maybe
size.
the
The
AUM you are
size is
mentioning.
a very, so Buffett has famously said that if I were to be running a $1 million right now, I guarantee you that I can make 50% on that. So in the world of investment management, everything else remaining the same, the expected returns is inversely proportional to the size of the funds that you are managing. That means if Rahul and Prince, you two are maybe, let's say, equally skilled, but Rahul has $10 million to run and Prince has $100 million to run, then Rahul's returns will be much better than Prince because Prince is managing a larger portfolio. In fact, when we pitch to any potential clients which comes to us, then we tell them that one of the biggest structural advantage, competitive edge that we have right now is relatively smaller. If I am running a 200 crore PMS right now, if someone else is running 2000 crore PMS and both are equally sort of skilled, then there is no way 2000 crore guy can beat me in the returns,
In that
because you
sense,
can enter and exit quickly. And the most, I think in India, the liquidity outside of BFSI is just not there in small and mid caps. In large caps anyways, it is very difficult to create alphas. Large cap can be more like long, you have to take those calls for the long term contrarian calls. That is the only thing. I think 2 years back, so we do very limited large cap, but 2 years back, the two stocks that we had picked, one was a bank and one was an agrochemical companies. They were the worst performing stock in Nifty, and I think last year they have been one of the best. So you can only be cyclical about it, and if you're contrarian, then you can make some alpha. Otherwise, they're very difficult to make, and that explains why most of the mutual funds and even the large PMSs are not able to make even 1% alpha. So that is one. So size is very important. As you scale, for example, when you invest in a small and mid cap, if there's a 1,000-1,500 crore fund which has invested 70-80 crores in a small cap fund, and if things go wrong and not as per the initial hypothesis that they had at the time of investment, they cannot exit. You cannot exit. You can only exit if things are panning out as you thought. If they are not, and the market price is going and more demand is coming for the stock from somebody else, a large mutual fund or something else, who can give exit to you. Otherwise, there is no exit. You are just holding something which will keep depreciating in value. And secondly, they will, you just can't sell. And if you sell, then you will cause a major damage to the price. So you cannot do that also, because then you will hurt your own NAVs and everything. So typically then you are stuck. Then it is like a private equity investment in a public company. So that is a very big problem in India, that there is just no liquidity in small caps. Typical good small cap company or a mid cap company is 60% owned by promoter, 10-15% by some long term funds. There is hardly 10-15% of float which is available, which is in most cases not even worth 1,000 crore in many cases. So then if you are holding 50-100 crore position, it's a very difficult thing if the company is not doing well. You have to then wait, and that will hurt your IRRs. Right. So that is, size is very, very important when it comes to investing. And now, for example, we cannot invest in less than 500 crore even with our size. So if I invest today, if I need 5-10 crore sort of a flow of a 500 crore market cap company, it is very difficult. It's important. And as I said, the more the size, the lesser will be the expected returns. The second question is on client selection. So at least at our end, we have decided to not do any outbound marketing. What we do is, most of the investors approach us, and when we are talking to them initially, we figure out if they have a sort of a long-term appetite to be in the market, if they understand the basics, etc. So that is very important for us, because in fact this is why war happened. Before that, this tariff thing happened, COVID happened, and we almost got no exits in all these durations. And I think that is the very, very important part. We don't want to just get the money for the heck of it. We want to get money from the right people, and that is why we also put the exit loads, which can be the maximum as per the SEBI, what SEBI allows, because we don't want people there are many people who will have very less exit loads, or they will not have, or they will have exit load only for 1 year, etc. We have the maximum possible exit load which is there for the 3 years, because only if they can invest with us and forget about the 3 years at least, then only it makes sense for them to sort of be with us.
So Sarvesh, on the return expectation front, what is a reasonable expectation from the market? If we can have some ballpark number, or any sensible person, or maybe any retail person who's giving money to you, over and above that part is totally fine. More the merrier. But my question is, what is the minimum expectation one should have at least?
So I think in the initial days, till one reaches 1,000, maybe 1,000-1,500 crore of AUM, I think if one is targeting maybe at least 3-4% alpha over the market, I think that should anyways be there for all the pain that one is taking to sort of come to a PMS and give the money to a fund manager, rather than doing it easily via mutual fund on an app or something like that. So I think that is the base case. But anyways, I mean, our track record is such that we have done that, but we can't guarantee anything. But I think that is the base case, and of course our internal, what we want is to do much more than that also. But again, that's always an aspiration, and that's where we work hard towards.
So one company you highlighted, the agrochem company, it has many subsidiaries, if I read it right. So in such cases, my question is, I mean, towards like the companies where we have many number of subsidiaries, it's not easy to understand what's happening inside. So on those stances, how you manage? This is one example, but broadly.
Yeah. So I think, see, sometimes there are aspects that you would not fully understand. So you have to understand. So the companies, the higher the valuation, the higher should be your understanding of each and everything into the minutest of the details. So that is what Buffett talked about, a bridge which can possibly take 60 tons. Now if I am driving only a 10-ton lorry through it, I should not worry too much. But if I am driving a 55 ton, then I should really be knowing what material is the bridge made of. Can I really judge whether this 60 ton is 60 ton? So that is called the margin of safety. So I think if the margin of safety is very high, and then you can sort of take, of course there are sometimes there are some aspects of the companies which you cannot fully understand, or which are very difficult to predict. but then you will have to then take the backing of the margin of safety and then also the liquidity part of it, because it may happen that you are wrong about it, because there are aspects that you will not understand or you cannot predict easily. So then you should have that ability to quickly sort of exit also in case you are proven wrong or if it is not going as per your thesis. So I think that is also very important. So when we sort of did that, I think both of these things were matching.
So, Sarvesh, one more question before I come to Rahul for his questions. So, you spoke about one rice company, right? So, you must have studied the peers as well. So as to understand the listed space, I think there are not more than three, four players who are relevant in the sense which demand our attention to say, and maybe one company or two company we may pick from that. So, what's the differentiation in the peers of the company you were talking about? Names are not important, but from business standpoint or to understand the subsector, sector, whatever you call it. So would appreciate your views around it.
No, in general, I'm not a very big fan of this particular sector, because it shows to, I mean, they try to show to us that they are like FMCG companies, but what is true that FMCG companies should have negative working capital. These are very heavy on capital sort of a thing. Also on the governance side, generally there have been challenges. Also there are challenges with respect to what the government policies are, and then you are also dealing with a very sensitive sector, which is farmers. And then more than that, you are dealing with farmers in North India, and we have seen how volatile those people are and those parts of the countries are. So net, I am not very positive about this sector in general. I mean, it's so we had invested in one more company in this space when during just after COVID, we made 3x and exited, and then it went up from there another 4 5 6 times. So was I proven wrong? Yes, but we were still happy with the outcomes that we got. We in general, we are not great fans of it. I think there's a lot of competition through private labels. Value is also shifting towards retail, quick commerce, those guys. So there are a lot of challenges also. If the company's promoters were the absolute highest level, and if the business models in terms of balance sheet, etc., was much better, then it could have been a different thing, but that is not the case in India, sadly. So that is one of the reasons why we keenly sort of track it, but we are not invested in it because of that particular reason.
It's also amazing how corporate governance is also cyclical. During the good times, corporate governance also looks good, and during bad
Yeah,
times,
no, yeah, that is true, but the perception changes with the stock price in the market. But I think when we are able to see something in absolute way, then at least at our place, we don't sort of rationalize it because of the stock price. So even in the company where we can see stock price doing well, but we are not convinced looking at the cash flows and all, then we don't sort of want to be a part of it.
Right.
And also because there are, that is what I said, in India there are just so many. The biggest learning that I have got in my 15 years of being an investor in India is that there are just so many opportunities. This is not like marriage, right? There's enormous opportunities. It's like dating 2000 girls are at your disposal. You don't have to marry everyone, right? So if you find one, so you know what Mangar also used to say, the inverse, right? So we are trying to find problems here, and if the problems are found and known problem, don't go towards it, because there are just so many. Today, as I said, we are getting less concentrated because we are finding just way too many ideas which are at decent valuation. So why I have to think about even one situation where there are known problems? I'll go towards situation where there are no known problems.
Yeah, I think that's two angles to that, at least from whatever I've learned, is that एक तो emotional and angle होता है. If you invest too much of your time, you tend to just think कि अब यही है. So that's one. And secondly, I think what happens is that if you are a retail investor and you take out time for research, so anyway, you're not going through a lot of opportunities, relatively speaking, to somebody who's full time and who's an analyst or a manager, fund manager. So maybe from behavioral angle, if you do find a decent, half decent opportunity and you spend time on it, because you're generally limited, people tend to get stuck with that.
Yeah. So that is why I think, yeah, I mean, if you're not a full-time investor, I actually feel
I mean, that's why
that you
Maximal
should just
Capital
focus on,
exists.
no, and more, even for smaller guys, right? Let's say somebody has a 10 lakh corpus. Why they should even waste their one day? Today the salary levels,
Yeah.
can increase so much if you focus on your own job. So just do it, do the mutual fund, go to the mutual fund route. Don't waste your own time and take out more time for your family rather than reading about a particular company. You are anyways not going to be, and then you will get stuck, as you rightly said. You are looking into one company and you get stuck into that. So for them, either they should go the mutual fund route or the Peter Lynch way, that okay, I am working in textile sector, I understand these 5 6 companies, let me just only invest in textile.
Right, where I understand. Yeah, yeah, got it. So I want to kind of touch upon maybe one or two of your past picks that we found out through our research. You can correct if that's not the case. One was GHCL, if I'm not.
Yes, yes,
That's true, right?
yes.
So GHCL is particularly interesting for me, but it came on my radar after where it is right now. But I think previously it was a demerger opportunity. So can you kind of sorry about that. Can you help us, just run us through the whole thesis and the journey? And
Yeah, so GHCL at some point of time, again, for that sort of a scale of profits and size, when we had invested prior to COVID, to us it looked like the most attractive from a valuation perspective. I mean, of all the companies which are trading with that scale, with that consistency of profits, etc., it was looking very, very attractive. And the important thing was that market had some corporate governance, etc., related issues, but we did a lot of thinking around that. We figured out that in our opinion it was probably the issues of the past and there was no recurrence of those issues, and the cash flows were real, the buybacks were real, the dividends were real, the cash management was being done exceptionally well in a very professional manner, and the company was doing every year a very asset light brownfield expansion which was adding to it. And then there was a trigger of the demerger of the relatively weak division.
yeah, that was
So all those triggers were there, and thankfully, it played out in the way we had thought. It used to trade at around 200 rupees when we first invested. During COVID, it actually went down to 70 rupees. And at 70 rupees, I mean, maybe, it was trading below one times future EPS.
right.
So it was that cheap, and even otherwise it was trading at 4 5 times, and we felt that. So the problem was that a company of this nature can never grow very fast, but still, I mean, the management was able to deliver 15 20% sort of a profit growth. And then once all these triggers played out, then we sold out, because then the only when we sold out, the only possible way of increasing profits was to do this greenfield expansion that they are planning to do. So I think that trigger was very
Yeah,
far away,
that's
because these things take a lot of time,
yeah.
and so we were able to make relatively good returns on this sort of investment.
Yeah, demergers are considered to be one of those special situations that work more often than not.
Yes.
Has that been your experience? And have you ever, just out of curiosity, have you done like a past 10-year study of, let's say, all the demergers that have happened and kind of done that?
Unfortunately, I have not done the study, but I think in general, I think they make good money. In case, again, it depends on, what the management. I mean, if there are two companies, one weak, one is strong, then in many cases they can make good money. If there are, and also, I mean, at least from our side, we should be able to understand and see the track record and all that. So many of the demerger take in many small, very small companies. So there we are not able to establish anything, because we need all that to be able to take a bet. So many demergers happen in very, very, very small companies, where unless you are pally with the promoters or know them or meet them and all that, so we don't do that. But of course, in all these companies which are known, I think in general it creates it is I mean, the probability is high that you can get a good.
In fact, though, I had one of the best experiences. I mean, one of the best talks of me was a demerger. It was AGI,
Okay.
and that demerged from Hindware. So that was a very happy story. And since then,
Yes.
I've been stuck on.
Yes.
Demergers.
Yes.
And you said they're too small, so I'm guessing 500 crores say under is something that you don't normally.
Yes. Now within 500 it would become very difficult. Within 1000 also it will become
Oh,
difficult
really?
for us. For our fund, yeah.
All right. So that was GHCL, and there's another one, PFC, which has
Hmm.
done very well.
Yes.
And actually, Anupam sir, who introduced us, I think he's been a beneficiary of your work. He's also an investor, if I'm not wrong. So he actually, we do a thing called GIC, Gurugram Investors Club, and we try to invite some people with very good domain expertise and everything. So we do physical meetups in Gurugram. By the way, anytime you're in Gurugram, we would love to kind of host you physically also. But he's from the power sector, and he told us a very interesting take from his perspective. We can get into that some other time. But aapka, how?
Yeah, so if you touch base with Anupam, you will understand that how much we have also spoken to each other.
Right.
So this is what I meant. Some part of our primary research is also related to, thankfully now within our investor base, we have expertise, we have sector experts. So we are also able to sort of get some input from them. But apart from that, of course, I mean, the stock was, before it went up, it was at 12% dividend yield. And we also run
Yeah.
a fund called Maximal Income Fund, and that's where we first bought REC, because we found that 12% dividend yield is just great. And a lot of PSUs have high dividend yield, but then their profits are inconsistent. So
Mm-hmm.
sale, at 85 rupees a few years back was at 10% dividend yield, but next year it posted a loss and zero dividend.
Yeah.
So you also, when you're looking at dividend yield opportunities, you also have to look at the consistency of the profits.
All right.
So here the consistency was there, so we found that it's a good bet for our income fund. And then thereafter, when we studied further, we found that all these GNPAs are coming down consistently. These are the triggers, right, which actually played in their favor, because earlier they were having much higher NPAs, and now their NPAs are getting resolved and the new slippages are not happening. So till that is there, I think it looked like an interesting opportunity, especially when it was at 10-12%. Now of course it's a different thing.
Right, right. Yeah, I think financials may over time at least that has been my learning. I don't know right or wrong. That as with most sectors, the best time to buy is when things are really really bad, which means usually आपके NPAs would be a little higher or
Yes,
highest,
yes,
and your
exactly. Financials are a classic cyclical sector, right? So you have to play or try to play counter cyclical.
the reason why I'm saying this is because I was coming from the school of thought कि financials may quality matters a lot. Like HDFC for example, and HDFC hasn't done anything for 5 years. I mean recently only last 1 year it's up 25%, but it didn't do anything. There were other instances where so yeah I mean so that it was a lesson that quality ठीक है लेकिन valuation कुछ होगा.
Yeah, yeah, yeah. Thank you. Thanks, Prince. Thanks, Rahul.
Thank you.
So perhaps, Sarvesh, any concluding remarks or maybe anything you want to pass on to our audience from your end?
No, so audience, as I said, I would assume most of them are themselves at a retail level. Firmly believe two things. One, if you are a retail investor, enjoy your life, focus on your job, because the income growth that one can achieve through the job is much higher than 1% additional alpha that you can generate on your portfolio by wasting your weekends. Spend that time with your family. Don't focus too much on the stocks. Focus either on the sector that you are already very well aware about, or you focus by just investing into mutual funds. That is one for the retail investors. For full-time investors, I think, as everyone would want, anyways know, I think I would definitely not say that value investing is the only way to make money in the market. There are hundreds of ways. Trading, momentum, everything is valid, right? But you have to be an expert on that. So I mentioned about 10,000 hours. So you have to diligently do your work. You have to read a lot. If you're doing all of it, then there will be a point of time when you will have enough capital and expertise, and life after that is beautiful, I think. So once you reach your first $1 million, and once you have done your 10 years, I think there is no other profession than being a full-time investor, in my opinion. So but for reaching your first $1 million, and for reaching your first 10 years, 10,000 hours of diligent practice, that you have to sort of pay.
Yeah.
That's the period of struggle which a lot of us have gone through. And once you done that, then capital makes capital. Then that's a very compounding story, irrespective of whichever way you pick. And there are many ways in making the market, so don't get dissuaded also because if you're not a value investor.
Right.
There is a way to make money. There are hundreds of ways to make good money. But value investing is something that resonates with us. I mean, I am a Bania by birth also, and it resonates. So I just love doing it. But yeah, there are many ways.
Perfect. One of the things I noticed about your social media presence is you're not very active either on Twitter. Maybe that's why your funds have been doing pretty well. So anybody who wants to reach out, what is the best way? If somebody is curious to talk to you generally and just, through the website would be best, or
Yeah, they can just there's a website form. They can fill out that form and reach out to us, or they can call at our landline number or contact details which are mentioned on the website, so they can reach via that, and we'll be more than happy to sort of engage further with them.
Perfect. Thank you so much. This is great from my side. Prince, you want to say anything before we close?
Yeah, thanks, Sarvesh, for taking out time on a Saturday morning and lovely interacting. Hope we connect again.
Thank you.
No insights. Thank you.
Thank you. Take care. Have a good day. Okay, Prince bhai.